But I just want to be careful with these kind of things and saying these kind of things, because just like the debt ceiling, it's clickbait. It's completely insignificant, the amount of this or that country that might be buying U.S. or selling U.S. Treasuries. U.S. Treasuries are the world's highest yielding debt, the deepest market right now. If you're short the dollar, it's a negative carry trade. It's not that complicated. And I've heard it since I've been in this business. I don't know how many times, I got to short Treasuries because the debt's going up. First of all, let's start with the trend. It doesn't matter right now. We're all turning to Japan. It will matter at some point. That's why Bitcoin is long-term I'm bullish. But right now, the biggest bridge that we have to cross is, as Dave mentioned, we're tilting towards this recession. What typically happens in recessions is the Fed cuts aggressively. This is not an opinion, that's a fact.
Mike McGlone, senior macro strategist for Bloomberg Intelligence, predicts that the second half of the year could be negative for Bitcoin and the rest of the cryptocurrency markets. In the upcoming months, risk assets like equities and cryptocurrencies may become less expensive, according to McGlone, who anticipates the arrival of a recession in the economy. The macro expert claims that the Federal Reserve is still on the path of raising interest rates, which he warns might have a detrimental effect on the performance of Bitcoin and other digital assets. Risky investments can become affordable during recessions, but they may encounter difficulties due to the cat-and-mouse game being played by the stock market's upswing and the central bank's ability to print money. Cryptocurrencies are among the riskiest investments, and the Bloomberg Galaxy Crypto Index's buy-size inability to hold above its 2018 high in 2023 may not have been for no good cause. The Fed is continuing to tighten. Largest crypto assets trading in USD are drawn to the BGC for performance. Furthermore, according to McGlone, the Bloomberg economics team expects a disastrous second half for stocks and cryptocurrencies. Our image displays a remarkable divergence, with the Nasdaq 100 stock index rising in the BGC and declining in the K2. Liquidity is measured by federal funds futures in 1 year, or FF13. Adding prices for cryptocurrencies could be capped by rising expectations of rate hikes in the current stock market environment. The Nasdaq and BGC have both surged by around 30% and about 50%, respectively, in 2023 as of June 1st. This may have shifted the tendency toward recessionary patterns. Risky investments are often affordable, he said. Let's begin the video as McGlone gives his macro insights on the Fed rate rises, the debt ceiling, and the state of cryptocurrencies, particularly Bitcoin.
Key thing I keep watching is every time I look on the Bloomberg terminal, I see we still have these bars that show they're going to be hiking in the July or June, July meetings, and I look at that and there's really no chance I see of things like an end to this deflationary forces we're seeing in commodities. Bloomberg Commodity Index is down almost 30% on a 1-year basis. We're seeing a little bounce in crude oil today, but I don't really see an end to that until you get well past an easing cycle. And we're not even started yet. So we heard trickling every day now. We've seen trickling downward in China, which has been my expectation for years, but not doing very well. And of course, they just pissed off their best customers, Europe and U.S. So that's kind of a problem, major disinvestment. But in the shorter term, the key thing is about OPEC Plus meeting cuts this week. And it's silly how people who are still trying to play that bullish game in crude oil, yet it's been in bear market since 2008. And I did say 2008 because that's when it peaked, and last year made a lower high. And people keep looking for that old scenario by looking at this old supply side that they still matter, but less so every day. And so we're getting a bounce again in crude oil, and that's what's been happening. We get a bounce on the OPEC cuts, and then it goes back downward to trend. So I see crude oil right now, it's pushing towards 75. It's still going to head towards 50. Natural gas has already done the equivalent. Commodities always go towards their cost of productions in the long term, particularly when you've seen kind of dicey inflation or economic demand, which is not so great. So they always go towards cost of production. And the key thing I'll end with that's so important we need to point out is cryptos are showing divergent weakness now. This is on a quarter, on the whole quarter now. Q2, the Bitcoin's down 6-7%. Bloomberg Galaxy Crypto Index is down about the same, and the Nasdaq's up about almost 10%. That's a sign of divergent weakness. Now, people keep saying the correlations have broken down. I'm like, yeah, they're breaking down the wrong way. The fastest horse in the race is warning everybody, warning us that there's a problem. I know I have to say this very carefully on this program because we all have to listen to ourselves and our views. Is McGlone saying what we don't want to hear? Or is McGlone saying what he really thinks and warning us? And this is one thing we always have to be careful. I add it myself as a trader and ex-trader, not like Dave who still runs money and you. I'm just out to point facts of what's happening. And I have to sometimes, I know in 2018, a lot of crypto people get very upset with me for pointing out facts and my views, but this is a fact in crypto space. My sense is most people think the worst is over, yet there's a good chance it might not be. Back to you. For 40 years, we've had a blip, we're heading back down. But there's key things sometimes that Dave and I have learned that's inherent in what we do, and that is absorbing, studying, and listening, and reading, and studying headlines 24/7. And it's something I've been doing for decades. And when I just saw that headline this morning, big U.S. banks face 20% jump in capital requirements, it's like, I'm not going to bother to click through that story. I just look, okay, the macro is already bad. We're already seeing a major jump in money leaving banks and going to money markets and two-year notes. And it's classic fractional reserve bank contraction. It's just, you can't face it. It takes a while. And then I see that headline, okay, well, let's just throw gasoline in that fire. So I just don't, it's one of those things that also you have to also remember in this business. It's very important to focus on the forest of what you're looking at and ignore those little trees that'll knock you off your view. And that's what I see. The stock market's a pretty good tree lately, but it is actually, I think, aggravating my macro view that this is the biggest reset of a lifetime by keeping that Fed emboldened, by keeping those rate hikes still hanging on over our head, as so many other things are collapsing. And the people focus on the lagging things like unemployment. That's so not important. Let's look at the producer price index. The fact, since 1948, it's never dropped as fast as it is now, and then I say that as a fact, should scare me. It should scare everyone. And what is being done to help alleviate that? Nothing. It's still going that. And the fact that we're having bank deposits on a year-over-year basis drop at the biggest, the highest rate in our database since the 50s. And what's out to stop that other than maybe just a pinprick every time one or two banks fall? Nothing. The macro's still bad. That's why I look at the big picture. You have to think at least 12 months forward. And that's where I'm still concerned that you see the Fed funds rate 12 months is still around 5%. And that's still restrictive because if I'm going to get 5% and guaranteed 10% in 2 years, why would I invest in any risk asset? Particularly if you start rolling over, cryptos have been doing. Treasury is the most leveraged market on the planet. You can get that financing for just about free. But to me, this is also part of the macro. Let's ask ourselves, can we not expect a reciprocal response to the biggest liquidity pump in history that's dumping at the greatest pace in history, and we've never raised rates this fast on a global basis? Can we? It's just logical. Yet the market's already priced that. It's okay, but that's human nature, and you pile on. Like this analyst is bullish, and that analyst is bullish, and I love hearing these strategies when people say, "Yeah, but so and so said this," and I say, "Well, what's their vested interest? Are they have a vested interest in being right and selling you that crypto, or selling you that stock market going up, or the crude oil going up and being right, or is it follow what they're paid to say these things?" You hear these major strategies from major banks coming out with these bullish economic things. I'm like, that's the difference with me. I'm paid to be right in the long term.
In addition to a larger OPEC Plus agreement to curb supply through 2024, Saudi Arabia will significantly reduce its output in July as the organization tries to support falling oil prices. According to the oil ministries of Saudi Arabia, the nation's output, which had reached a record high of about 10 million barrels per day in May, will decline to 9 million barrels per day in July. This candy comes from Saudi Arabia. "We aim to ice the cake," the Saudi Energy Minister Prince Abdulaziz said during a press briefing. "We constantly strive to increase tension. We don't want anyone attempting to forecast what we'll do. This market requires stability." Around 40% of the world's crude is produced by OPEC+, an association of petroleum exporting nations and allies led by Russia. Therefore, the group's political actions can have a significant impact on oil prices. International benchmark Brent crude prices rose temporarily in April after a surprise decision to reduce supply, but have subsequently fallen as a result of worries about the state of the world economy and its effect on demand. Brent traded down to $76 on Friday as the week came to an end. Saudi Arabia is the only OPEC Plus member with enough storage and spare capacity to be able to readily decrease and boost output. When the coalition of producers adopted record output cuts in the early stages of the pandemic in 2020, it was able to quickly react to excess supply that was destabilizing the market. The group decided on Sunday to drop total production levels from January 2024 by an additional 1.4 million barrels per day compared to present plans, for a combined 40.46 million barrels per day, in addition to prolonging the current OPEC Plus cuts of 3.66 million barrels per day. The group adjusted the targets for Russia, Nigeria, and Angola to put them in line with actual current production levels. Thus, many of these cutbacks won't actually happen. In contrast, the United Arab Emirates was given permission to increase their daily output targets by almost 0.2 million barrels. According to McGlone, the outlook for the world economy is bleak, and trading in these extremely unpredictable times requires considerable discernment. Which rate increase do you anticipate the Fed making next? Please share your guesses in the section below. Also, don't forget to click the like button, subscribe, and enable notifications. Thank you for watching.